Good morning, and welcome to our panel, Global Derivatives Markets, a New Policy Agenda. And is the public policy agenda changing for the financial and derivatives markets between the U.S. and European elections, Brexit, concerns about economic growth, monetary policy, and international trade? There certainly are reasons to think so. Let me give you a case in point from my own personal experience. I've been to the White House in Washington a couple of times, once quite recently and once during the prior administration. Both visits, as you can imagine, were quite memorable. They were also quite different. The first one in the prior administration mostly involved listening and taking notes. But at the end of it, I did take away a special gift, which I have with me here today. And I know these are too small, and you can't see them, so I've taken pictures of them. And that's what you got when you visited the Obama White House. Clearly, another case of American exceptionalism. It's a box of presidential M&Ms and a box of presidential Hershey Kisses. So that was the first trip. And I've saved them, obviously, because they mean something. So that was the first trip. What about the second trip? Well, sadly to say, there were no chocolate goodie bags. But the discussion about financial regulation was a whole lot more constructive. So I think that was a good trade. Clearly, the winds of change are blowing, and it's not just in Washington, but in Brussels, in London, and other financial capitals. And we're here today to consider what this means for the global financial and derivatives markets. And you can see on the cover of our new IQ magazine, which I hope you all take the time to take away and to read through, we posit that there's a recalibration of sorts going on the financial regulatory agenda. And that recalibration reflects in part the relative success the industry's had in implementing the G20 derivatives market reforms, clearing, margining, trade reporting, capital, and trade execution. But there's a lot to discuss here, obviously, and we're very fortunate to have a special group of panelists discuss and work through these issues, and I'd like to introduce them now. One panelist is likely the most intelligent person you'll ever meet. She's excelled in science, banking, and in politics. And for those of you who were at the event last night, you will know she's a quite competitive croquet player. A warm welcome to Kay Swinburne. Another panelist is a noted academic who formerly held positions at the U.S. Treasury and at the Council of Economic Advisors. He's a professor at the University of Maryland, and he co-chairs the Bipartisan Policy Institute's Financial Regulatory Reform Initiative, all the way on the end to my left, Philip Swagel. Another panelist all the way to the right has led one of Europe's most important and respected think tanks for the last 17, 18 years. That would be Carol Lanoux, who is the president of the Center for European Policy Studies based in Brussels. Welcome, Carl. Our next two panelists are current ISDA board members. One panelist has held leadership positions on the sell side, on the buy side, and in the public sector, including at the U.S. Treasury and the City of New York, Darcy Bradbury from D.E. Shaw. And last, but certainly not least, one panelist is the only person I know to have entered university at the tender age of 16 and to have worked at the same financial institution for over 3 decades as a trader, as a business unit COO, and as a senior executive in its global corporate and investment bank. Of course, Eric Litvak is this chairman. So we're going to start the discussion off with some live polling, which I hope you will take the time to provide your views on. With all that's going on, we thought we would ask Given the political and economic environment, what should be the top priority of policymakers today? And I would ask you all to vote and provide your views on this. And we should see it displayed, the results displayed in something close to real time here, yeah? Processing. Perhaps not. All right, as we wait for the results to come in, let me ask my panelists the same question.
There we go.
Here we are. Okay. So the choices were, which of the following should be the top priority of policymakers? Ensure financial stability, reduce regulatory complexity, generate economic growth, and it looks like ensure financial stability is top, and reduce regulatory complexity is right behind it. And so let me turn to the panelists. Philip, I think I'll start with you. What do you think of the results? And how would you answer that question?
It's interesting. I look at this as, in some ways, reflecting still the legacy of the crisis. I would have expected this audience to come in with B or C as number one. So my sense is that of these three choices, right, there's trade-offs, and we can have at most two of the three, and more likely only one of the three. And that's of course the dilemma for policymakers. We saw in the wake of the crisis that the focus was overwhelmingly on number one, on stability, and in some sense we might even say perceived stability, which at least in the US you can see is reflected in, say the Lincoln Amendment or the Volcker Rule, aspects of our regulatory system that the appeal was really the symbolic appeal. So that's what I'm looking at going forward, is will the changes in our regulatory system move toward B and C, and especially keeping an eye on the trade-off between A, B, and what the impact is on C on growth. To me, that's the big question for the US at least.
Great. From the US to Europe, Carl, how do you feel about that?
I'm personally surprised if I see this result. I would think, let's say, for a policymaker, the main priority is economic growth. And certainly, I think this audience are mostly market people. I think it should be economic growth. I mean, what you've heard in Europe for the last 10 years is jobs and growth. I mean, it's nothing else. So ensuring financial stability is kind of a measure for almost everything and almost nothing. I mean, where does it stop? Where does it end? And reducing regulatory complexity, I think, is probably not a priority for policymakers. It's just the opposite. They want regulatory complexity, but they want to give jobs to themselves. If I see what has happened in Europe for the last 10 years, it's just increasing regulatory complexity. If I look at the recent proposals which Stephen did not mention, like, for example, the capital reform package, which was issued in November by the European Commission, with the amendments to CRD, BRRD, SRB, etc., it's just an enormous piece of, again, increasing regulatory complexity. So I also, let's say, sitting in a think tank in Brussels, I have a big problem, not only me, all my colleagues have a big problem in just coping what is coming out at the European level, at the national level, but also at the international level.
I'm going to ask Kay to respond in just a second, but we couldn't sort this geographically, but just a quick show of hands. How many people are here from continental Europe? Okay, pretty good. And how many people from London?
So yeah, that's not continental Europe.
Yeah. And the US? Okay. I wonder if that's, and Asia, sorry. Yeah, very good. Okay.
As one of those policymakers, I can tell you jobs and growth is the top priority, but they're intertwined. I mean, you can't have one without the other. So unless you've got financial stability, unless you've got a good regulatory environment, you don't have the environment to have economic growth. So I think the two are completely intertwined. And I think the last 8 years, We've focused on putting the framework in place so that we have financial stability and we have a globally consistent regulatory environment, particularly for global capital markets. And then within that framework, we now have to go back and reassess those things that maybe are impairing the movement of capital, those things that are preventing companies from getting access to the funds when they require it to grow. And so I think the three are completely intertwined, but the third is completely dependent on the first two. And I think we've now got to stop focusing on those two other than to make the changes required to allow that capital to flow. But we've got half of Europe, between the UK, France, and Germany, half the population of Europe will be at the polls this year. And that means every national politician will be talking about economic growth and the jobs that are generated from it. And so the fact that Europe is so focused on jobs and growth, hopefully that means capital markets benefit. Because ultimately, if the capital markets aren't providing the relevant funds, the relevant investments when it's required, we won't have economic growth anywhere in Europe. And that's going to be a big problem.
Eric or Darcy, did you want to?
I'll be brief. As always with Stephen, which you missed, this was something of a trick question. I agree with Kay and Carol that you have to separate A and B from C, given the nature of the question. Clearly, the policy, the objective of policymakers is not ensuring financial stability or reducing regulatory complexity. It's generating, and I would want to change the question, it's generating sustainable economic growth. That's a policy objective. The prior two are just how you get there. They are, to a certain degree, supervisory concerns. They're not policy. You don't build a society around reducing regulatory complexity, or you don't build a society around ensuring financial stability. Those are just the things that get you to what you want for society and why you make choices in society. And your objective there is to generate sustainable economic growth. And as Carol says, I mean, it would be lovely if we could get to less complexity. It's certainly something that we, as an audience, all would like to tend towards. It just seems that we never get there. The more we aim for greater simplicity, the more we end up with greater complexity.
So, I mean, I think I'm not quite that tricky, although I can be. But to follow up on your comment, generating economic growth should be the top priority. Do we think policymakers are sufficiently focused on that in this environment?
I think, overall, let's say if I look at all the statements by policymakers, by the presidencies of the EU, say by the different countries which have the presidency of the Council, I see it is mostly always in there, jobs and growth. But if I look into practice, and certainly in the area which you are all following, the financial markets, I think it's more, sorry to say, creating regulatory complexity. We see always more complexity coming out, and it's always more difficult to follow what is going on. Of course, if I look at these objectives, I would say mine would be, certainly in your field, CCPs and derivatives markets, it would be reducing or say controlling, monitoring interconnectedness. So just trying to know, to understand what is the connection between all these market participants, also now in the context of what Stephen mentioned, for example, Brexit, what is going to happen with Brexit, what is the connectedness between London, Britain as a financial center and the rest of Europe, how can we monitor this process over the next 2 years and how can we manage it in a fluid way? That, I think, is one of the key objectives. So financial stability as a broader objective is extremely difficult to say what is comprised by financial stability. I think it would be much better to be precise and to say, look at connectedness and look, for example, at what the Commission said in its paper related to the EMIR review, is to look at who are all these participants in the market. Do we have too much concentration in the market? Is there a danger of concentration? And there again, let's say we can compare the US and the EU. Probably if I look at the EU, the size of the banking system, which is probably still larger than it is in the US as a percentage of GDP, has declined. I think the size of the banking system in the US may have still increased, or certainly the concentration of the US financial system has increased. And that would be, from my perspective, a concern.
Philip, in the U.S., I'm sorry, Darcy, please.
Well, I was just going to add one quick thought, and is there's a real time lag here, because a lot of the regulations that we're complying with or even about to comply with were drafted at a time when the sole focus was financial stability. And so I think that the policymakers like Kay are ahead of the regulatory bodies and where the market is, unfortunately. So that time lag makes it very difficult.
I was going to say, in the U.S., when I look at the debate that's about to take place, it's going to focus on banks first, right, and small banks. But eventually, it'll get to issues, that matter here. And the one that I'm really focused on is the discussion of resolution, right? We have the proposal in the U.S. House of Representatives that would change the rules around the market's utility. And then change them in a way that's connected to resolution. I try to get rid of the resolution regime that was put in place by the Dodd-Frank Act as it relates to the market utilities. But then, of course, you get into a situation of, well, if there is another crisis, and of course at some point there will be, well, what is the regime, right? What is the failure regime? And there's a sense in which that, at least in the U.S., that's what we haven't really wrestled with, is what do we do when the next crisis comes around? Right, and Steve, I think it's because we're still so focused on the questions arising from the last crisis, and getting the regulations right and getting the impacts on growth right. So that, anyway, that's the thought I'd like to just put out there, is to say, well, what about in the next crisis? Do the rules we have in place, do they work well? And this is one of the ones I'm worried about.
I mean, do you think in the U.S. policymakers are getting it right in the sense that they're putting economic growth at the top of their agenda?
It's coming. I mean, in the sense of, immediately after the crisis, it was definitely not, right? Growth was really very far down. There's a sense of the cost of the crisis was so vast that any rule was worthwhile. And again, Lincoln, the Lincoln Amendment was, by far the sort of poster child for that. Fortunately, that's since been repealed. And so now there is a sense, even among the regulators, the Fed now is willing to talk about the costs of growth and the trade-offs involved. So we're moving in that direction. Look, it's just the nature of our political system. It's harder for us to put these kind of longer-term issues at the forefront of our decision-making.
Great, thanks. So let's drill down a bit and talk more specifically about the derivatives markets. And our next question is, specifically with regards to derivatives, which of the following policy issues should be the top priority? Capital, margin, trade, execution, data and reporting, CCP, resilience, recovery, and resolution. And data and reporting rarely ever wins polls like this, but feel free to vote your conscience. And, so it looks like capital, maybe. Data and reporting take heart. All right, so let's assume it's going to be capital and CCP, resilience, recovery, and resolution. Eric, starting with you, is this how they would line up in your mind? Do you agree with this? And why?
This is one of those Alice in the Cheshire Cat questions. Once where you want to get to depends on where you're starting from and what road you're going to take. Look, clearly all those are important. I'm probably broadly in line with where the audience has come out, but that's because I approach this as a banker, so my primary driver is capital allocation and the resilience of my counterparties. And today we're going into a world where, as a provider of market services, our single biggest counterparties across the board are clearinghouses. So clearly the thinking around CCP resilience, CCP transparency, CCP recovery plans, and ultimately CCP resolution are very much dominating our internal debates today. Trade execution and data reporting, they often get short shrift in this sort of poll. They're still incredibly important because they do ultimately reflect the way that we avoid fragmentation and that we can ease the efficiency of risk transfer and provide supervisors with the appropriate insight into that process. So all of those are important, and it's important to give all of them the appropriate focus.
A quick question. Can the people in the back hear us okay? Feel free to speak freely, yeah. Okay. Okay, so we'll either speak in the mic or turn the volume up a little bit, please. Darcy, Eric's sell side, your buy side. Do you agree with the audience?
So I'm going to talk loud. Let's see if that helps. So one of the things that's interesting is that trade execution is not much of an issue, and I would argue that that's because the changes that have been instituted are going well. The move to CEF trading for highly liquid swaps, which nobody was very excited about initially, is working well. And so it's not a concern for most firms. From my perspective, margin is and will continue to be a big issue. It's just the flip side of Eric's, capital. And one of the concerns is I feel that the banking regulators kind of overweight capital, and the securities swaps regulators, which is, of course, how we've insanely divided it in the United States, overweight kind of margin as an issue, and really they need to think about them together. And so I think the interplay between those two will be very important going forward. And we're concerned in particular about the impact of margin on non-cleared trades, which hasn't hit us yet. As a buy-side firm, but in fact, we've been posting margin on non-cleared trades pre-crisis, forever. Nobody's doing a swap with a hedge fund that doesn't post initial margin, but the rules were set up to make that punitive, with the idea they had to encourage clearing, but in fact, there are trades that are non-clearable. They're not just uncleared, but you can't clear them. They're complex, they're customized, total return swaps, things like that. And I'm concerned that in several years, if that issue isn't re-examined, the levels of margin that would be imposed on non-clearable swaps are going to be quite uneconomic and in fact not reasonable. And so I think as they go forward, I look forward to a more informed conversation about are the current level of margin that the buy side's posting for non-clearable swaps adequate, or do they in fact need to be significantly ratcheted up as the current proposals would suggest?
Steve, can I ask a question?
Sure.
So I just wanted to ask Darcy a question, which is it's really a great point. And I was wondering, has there been any this level of of knowledge building among the regulators? I mean, as you explain this issue to them, do they learn, or is there some sense in which these swaps are just so complex they can't learn, or we as a market can't learn?
Well, I think we've just started talking to them about it. I think for the last while, the end of the Obama administration, and then with MiFID II coming in, basically the regulators and policymakers weren't really able to hear you when you talked about something that might happen in 2 years' time. But now with the US administration obviously focused on, recalibrating regulation in the US, and I think with the EMIR review and then implementation of MiFID II, there's a real opportunity here to start the conversation. It's very important that they really think about the interplay between all of these factors, because to Kay's point about economic growth, these markets exist only to support the real economy. And if you make people, if they're not able to use certain financial instruments that are vital to hedging or investing, then, that can't be the right outcome.
So just a quick follow-up, Darcy. The focus on CCP, resilience, recovery, and resolution, the buy side is vested in that issue as well?
Of course, right? We were big supporters of central clearing because it reduced our counterparty risk, so we don't want to substitute risk of company A failing with risk of CCP A failing. I think that we have some confidence that the CCPs and the policymakers are thinking about this correctly, and that's why I wouldn't have put it at the top of the agenda. It's, you know, it seems like it's a given that they would be sound and sensible. When I was asked this question a couple of weeks ago by a senior policymaker in the US, I said, I think the most important thing is that we don't force the CCPs to do things they're not intended to do. And so as long as they're clearing highly liquid swaps where there's regular pricing available and they really understand those instruments and can make sure the margin levels are appropriate and all, they should be fine. The problem becomes when you use them as a political tool and start forcing stuff into central clearing that doesn't belong there.
Okay.
I just have to put a plug in here. Given that I'm the lead negotiator for the EU on the recovery resolution file for CCPs, of course it's the most important.
Carl?
Yeah, I would agree. Let's say the last item, let's say to what Kay said, let's say recovery and resolution is the most important thing. I mean, you have to realize, let's say, like Stephen was saying a moment ago, we have created EMIR. Before EMIR, we didn't have any mandatory requirement for central clearing in Europe. Let's say everything was happening on a bilateral basis. Now we have about 3 to 4 CCPs in Europe which basically concentrate all this risk. So first of all, the supervision of these CCPs is a key issue, and then secondly, the recovery and resolution. But if I look at the CCP resolution piece which was proposed by the Commission in November, and also Stephen was referring to this, the supervision will still be with colleges of supervisors. But can you imagine, we're basically supervising 3 to 4 CCPs in Europe with a college of probably 15 or 20 supervisors. How could they do their job properly? Of course, the Commission is now trying to change a bit its course after Brexit and say, well, we may consider some changes. But I found it rather dramatic also that Stephen has to call here in public, look, we need to have the budget to do our work, and we cannot do this work. So if I hear this, I would be extremely concerned if I see that there are 3 to 4 CCPs in Europe which concentrate all the risk. On top of that, me as an outside observer of this process, I hardly have any data about the risks which are concentrated in these CCPs. I may have it probably a bit from LCH. If I want to have it from the others, it will be much more difficult. I would be extremely concerned, given that situation, whether this supervision is properly done. I can also reflect to open seminars about the subject. In June last year, there was a seminar on this at the ECB, where Stephen and his collaborators expressed the concern. Also, Benoit Corré from the ECB has expressed the concern about how is the supervision of CCPs going on.
Yeah, I just want to clarify that Carl's referring to Stephen Mayor, not Stephen Kennedy, when he's talking about ESMA's budget. I'm a little bit surprised by the trade execution vote level, particularly given MiFID. Eric, thoughts on that?
Well, the trade execution mandate isn't gone live yet in Europe, so it's something that we're all worried about in terms of obtaining the appropriate clarity as to what we're going to implement. I think there's still a great deal of uncertainty in the European industry in terms of exactly what falls into the scope of pre-trade transparency, what instruments are like. One assumes that it's going to be similar instruments to what is in the US. Broadly speaking, the outlines of the proposal in Europe at a high level are in line with what one would have expected. I think that the trade execution rules will probably get reviewed somewhat in the US in order to allow more flexibility in the different manners of execution. And I think we'll probably get some more comment on that from Acting Chair Giancarlo tomorrow morning. But I think in some essence we will probably see more convergence in the US rules towards where MiFID is expected to come out. That being said, it's still a work in progress. We're still waiting to see where equivalence rules are likely to come out, substituted compliance rules are likely to come out between the EU and the US, because if all this were to go live without any substituted compliance framework, we're potentially in a conflict of laws framework if you trade between the US and the EU. Which framework do you apply, and are you confident that it's respecting both. So that's some important lines that we need to cross before we can go live with trade execution. But I think the broad framework on trade execution itself, setting aside the issues of product identification, which we've expressed some concerns with, setting aside some issues with pre- and post-trade transparency where we have uncertainties in the framework. I think the concept of trade execution as it's articulated in level 1 in the primary legislation is broadly where we would expect it to be.
Yeah, and Kay, I know that there's legislation winding its way through Europe on capital. There's some divergence with the U.S. How concerned are you that, and we're going to get into globalization more broadly in just a minute, but just for right now, how concerned are you about the potential for divergence in capital going forward?
Well, as an advocate of global rules and trying to get increased global cooperation, and certainly I've stood on platforms like this for the last few years advocating that, I have a huge sympathy for the way in which the EU effectively is being forced to take a slightly different path to that which has been arguing in Basel. And I think the Basel Committee has demonstrated an extreme reluctance to actually really grab the issue, particularly of capital and margin, correctly. If we have no clearing members left, why on earth have you got a clearing mandate? Because you actually need to have the incentives aligned so that you've got proper clearing members able to stand there to provide the services for their customers. If the capital issues are incorrectly aligned, you are never going to have those clearing members there. And so you've got competing objectives of the G20 with regards to stability and the capital requirements and the requirement to centrally clear. So I think the Basel Committee has to actually be a lot more aware of these conflicts and be prepared to actually change the rules with regards in particular to the customer's margin that's posted and therefore make those capital allowances for those clearing members in order not to disincentivize them for doing the right thing and staying in the market and providing that service for customers. I think Basel has been too slow, and given I understand it's one large country who has dragged its heels on this, I hope that we're seeing some movement, and certainly the rumor in the last 24 hours is that the Basel Committee is moving. And so I hope they will move to where Europe has already decided it has to go in order to make sure that clearing mandate is maintained.
I'm not going to ask what the large country that's dragging his heels is. It's not Brazil. Philip, thoughts on where the U.S. is headed with regard to capital? And I know there are different strands of within the U.S. Political framework arguing for different things.
Yeah, it's a time right now when we're moving in both directions, right? There's still lots of concern about the role of large banks, and that would lead you to say, okay, we need more capital in the U.S. Then that would lead you to discuss the Fed's TLAC rule, right? Where people look at the Fed's idea, and it's just hard to be confident that TLAC's going to work as intended, right? I mean, the idea is that essentially it's our version of convertible capital, bail-in capital. And I think anyone who looks back at the experience of the TARP and thinks about, right, when the next crisis comes, are we going to, tell the bondholders of Lehman Brothers, okay, congratulations, you now own the firm. It's just hard to be confident that that's going to work as expected. On the other hand, notwithstanding the concerns about large banks, we have the trade-off with growth, and I think there is a concern that that the capital levels that institutions are funding themselves with now are having an impact on growth. Right? It's hard to say, okay, here's how many percentage points of growth additionally we would have were it not for the capital levels. But that's the other part of the discussion. So in the U.S. at least, we just haven't sorted this out. And I think you're going to see kind of the discussion moving in both directions until there's some resolution.
Good. So I think that there's generally a broad consensus that you all, that the panelists agree with your the way you're ranking. Although I think the buy side would argue that maybe too much attention is paid on capital and not enough on margin, or at least on looking at them holistically. Let's go to a slightly broader topic, and one that's obviously very important to us in the global derivatives markets, and that's the issue of globalization. And we'd like to get your views on, are we seeing a change, or have we been seeing a change in the decades-long trend towards the globalization of markets? Is the trend reversing? Is it paused? Or are they continuing to globalize? Wow. So 70%-ish think that it's either paused or reversing. Kay, how would you respond to that?
I think the fact that it's so mixed suggests that nobody really knows. And I think ultimately that's the same situation as in 2007-8 during the crisis, where regulators and supervisors around the world suddenly realized how interconnected the global capital markets were, and indeed how global they really were by product. And I think it's been really important to understand that interconnectedness and the global appetite for these products to actually know no boundaries. And it was very apparent to us in Europe that German investors were caught with products that ultimately were dependent on US real estate. And so that interconnectedness all the way through from policy level of one nation actually affecting investors in another. I think the one thing we've now seen is that regulators and supervisors around the world actually realize those globalized markets need a global cooperation that they didn't have pre-crisis. So for me, whether or not the global trend is increasing or decreasing or staying the same is actually a second order effect, really, because the market's going to find their own place. But the supervisors need to act more global. And I think post-2009, we've seen a massive increase in the international cooperation between supervisors. We've seen a standardization of the rules, so we've got a similar set of rules, particularly in the derivatives field. The G20 Pittsburgh work has been really critical to make sure that the regulators have got similar rules to apply. We see that increased cooperation in all sorts of fora around the world, where they talk on a regular basis. The global colleges are working for global players. So you're actually seeing that increased cooperation, not just in Europe, but across the globe. And I'm a lot more confident now that if a global clearing member goes down tomorrow, one of the very large players, we'll have a very different level of cooperation amongst those supervisors across the globe. So whether or not globalization by product is increasing or decreasing, I think actually the supervisors will continue their globalization in terms of their cooperation, in terms of trying to get their rules a lot more similar. And therefore, I think the framework that allows that capital to flow doesn't impede it, but allows you to do it in a safer way, is the real question that I think has been answered by the crisis and post-crisis action. And I think politicians may want to fragment. And we're seeing lots of stories, and the Brexit question and the Trump question have led to people saying this is going to be more about promoting your local markets to the detriment of the global markets. Well, I'm a great advocate that the markets will find their way around any national rules that are put in place. So if Europe, continental Europe in particular, post-Brexit, wants to put in place the location policy for euro clearing, then why on earth would you think that the markets are not going to find a way around it? For me, anything that actually causes market fragmentation, causes costs to go up for end users, the market will find a way of serving their customers at a more efficient place. And I suspect that that will be outside of Europe altogether if you start putting location policies on euro clearing. Or it means that you'll end up with back-to-back trades and all sorts of innovation in the financial markets in order to get around these rules. When people say we have to repatriate euro clearing has never had a destination. It's always been done on a global basis. The euro is a modern currency. It's one that has never been subject to a location policy in the past. So it's not about repatriating, it would be about patriating. And that is completely flying in the face of what the euro was designed to be in terms of a rival global currency to the dollar. So I'm a little concerned that the rhetoric of national politicians is about grabbing things back and taking things with a location policy. But ultimately, I think the crisis taught us the interconnectedness of global financial markets is here to stay. And anything you do is going to punish your local customers, your local banks, as opposed to preventing that global trade from happening. And I think any politician with a national agenda needs to be very careful that they don't just punish their own players rather than actually prevent the global tide.
Interesting. Carl, thoughts?
I think we are somewhere in between B and C. I think, let's say, people hope, let's say, that globalization continues, but we see some trends. If you look, for example, at the growth of trade, which has been declining a bit, let's say the overall growth. I don't say that trade has been declining, but just the growth of trade has been declining a bit over the last 2 or 3 years. So it may be, let's say, that there is a pause in the globalization trend, but I would agree with the previous speakers. Let's say that basically, I mean, markets will continue to globalize. Let's say it's very difficult to stop this process. And we have seen, I think, over the last months, let's say, many examples that it is almost impossible because our value chains, certainly in goods, are so interconnected, let's say, that we cannot reverse this trend. We need to have global suppliers for global goods. The same, let's say, applies for services, and I would also agree with Kay, let's say, that we will see this in financial markets. It will be extremely difficult to reverse that trend. Of course, we have gone towards the global market also with allowing, also in a European context, every player to specialize. If we want to reverse that, let's say, this will create inefficiencies. We, by the way, did at CEPS a study, for example, for the European Parliament on the cost and benefits of Brexit. We see it's a cost for all the European Union countries. It's just because we are creating more fragmentation. Of course, it's a limited cost, certainly for countries further away from the UK. But for those countries, of course, the UK, Ireland, and around the UK, taking Benelux countries, Germany and France, it is a bigger cost. So it is increasing fragmentation. So at a EU level, we see the cost of this. It would be the same at a global level if we're creating more trade barriers.
So let me summarize what I think I've heard. I think I've heard that the supervisory approach and framework has become much more global since the financial crisis, and that the markets will inexorably move towards greater globalization in what used to be called innovation and now is called regulatory arbitrage. Philip, how do you feel about that?
You know, in the U.S., I look at our supervisors as in some ways pushing back on this. So I think you're right, and B, you know, I look at the Fed with its intermediate holding company rules as essentially trying to push back on this. And then the same thing, the CFTC, certainly under Gary Gensler, you know, maybe less so under Tim Assad, but Gary Gensler certainly was trying to avoid this sort of ceding of supervisory or regulatory authority. So I think you're right. We had the pushback. I don't know under the next regime, I guess we'll find out maybe a little bit tomorrow morning, whether this will continue. But certainly there's a skepticism in the US of, you know, of this globalization trend.
Eric or Darcy, did you want to add a thought?
Well, I was pleased to hear Kay say that market participants make their own decisions about where to conduct business, and that part of what you're trying to do as a policymaker is create a rational set of rules that people can understand and make it an attractive place to do business, because we are going to have to make decisions, and if we find it's either not economical or the rules are too intrusive to trade in different locations, you're going to shift where you do your business. We have a fiduciary duty to our investors. We need to protect our business, and I think that, the other thing is that globalization is not going to end. We're a global economy. The question is, where are you going to invest? And if you want to attract investment, if you want to promote your economy, back to your economic growth thing, I think you do need to think about the costs of investing, and have you imposed too high a cost or too burdensome a regime to make it attractive. And we've, from time to time, felt that the European rules are a little over-engineered You know, I know that's in context because, as you mentioned, the CFTC rules, which also sometimes feel a little particular, but I do think people, it's not a bad thing to kind of step back with a 5-year mirror review with what's going on in the US and say, oh, could we just recalibrate a little bit to reduce some of the friction, the transaction costs, while maintaining the general trend to promote investment.
Thanks, Steve. Yeah, no, I think in terms of the whole debate on is globalization rolling back as it hit a wall, as long as you have international trade in goods and services, you will still have international capital flows. So you will still have global markets, regardless of how you look at them. Capital flows don't respect borders as such, but the way in which we regulate capital flows in financial markets and the offer of financial services is a national prerogative. So investor protection, financial stability, they're all regulated at the national level. I think what we've seen is not so much a pause or a reversal in globalization as a pullback from an environment that existed prior to the crisis. And I think if you look back to the world prior to the crisis, we all agree that certain markets were fairly tightly regulated on a national basis, and other markets were considered to be institutional, didn't touch the retail market, and therefore could benefit from what some people call the lighter touch approach, what other people call the laissez-faire approach. I mean, that's again, is dependent on your perspective, how you characterize it. But we've had something of a pullback from that as there's been a global consciousness, and I think this is the point that Kay was making early on, that that all of these are interlinked, and you cannot simply assume that because certain markets are institutional, they don't have ramifications into those parts of the market, those parts of supervision and regulation that you are nationally charged with in terms of investor protection, in terms of financial stability. And so there is a pause, and I think the audience has got that one right. There is a pause while there's a general catch-up to bring all those other parts of the market that were previously subject to a lighter touch regime into a more global framework. I don't think we're going to move away from the concept that you have global markets and global capital flows. I don't think that we have a world in which ultimately you can retreat behind national frontiers. But we are in the process of a great readjustment of our financial supervision framework. And that's what we're seeing now as we sort of pause and take stock and see how we move forward and take smaller steps in what is a very complex dance of how you bring the institutional market into a regulated framework.
Good. I want to move on to our next issue, which is a little bit contentious, and we'll see what you think. And it's about too big to fail. And one of the premises upon which the post-crisis reform agenda was constructed was the desire and the need to end too big to fail, to ensure there would be no more government bailouts. Have we succeeded with this goal? This is just yes or no. We'll wait for a few more votes to come in. I'm going to throw this. Philip, do you want to take us out on this?
Well, I certainly agree. I was one of the 87% here in my vote. Like I said, we're still wrestling in the U.S. with too big, the first part of too big to fail. Our political system is wrestling with the to fail part, and that's what I'm really looking at in the regulatory discussion that's happening now in the U.S. Congress. And there's a sense in which all the issues that we've discussed, I think you can draw a direct line between various events during the crisis and those issues, right? So all the sort of central clearinghouse, right, draw a direct line to Bear Stearns. The international regulatory issues draw a direct line to Lehman Brothers. maybe AIG, but especially Lehman. And so the to fail part, of course, is AIG and Lehman. We have a new system in the U.S. under Title II of Dodd-Frank. Obviously, it's never been tested. The FDIC and the Fed have done a lot of work, and now there's a lot of pressure to roll that back. To me, that's the tension, as I mentioned before, in the U.S. is, okay, are we going to roll that back? And if so, will we replace it with something different, or just leave it unreplaced? And in some sense, I would say, look, I'm a Republican, but I would say if we get rid of Dodd-Frank Title II, that leaves us with a system in which there will be a future bailout, because then, a future president will take the same sorts of actions that we at the Treasury took in 2008. And I don't think that's too self-serving. I think it's just realistic. But that's in some sense the challenge that we in the U.S. face.
So, quick follow-up. Are the too big to fail institutions today the CCPs or the financial institutions, or both?
It's both. And today, in some sense, we have a better handle on the banking side and less of a handle on the clearinghouses.
Okay. Let's just go right down through. Darcy?
Well, I think I was a minority as an American to think that what the Fed did and what the Treasury did was correct last time. I think the government has a role in a crisis and should be able to step in and stabilize a financial system. But obviously, I was outvoted by the American people pretty dramatically, since the bailouts, as they were called, despite returning untold riches to the U.S. Treasury, were deemed politically inconvenient. I personally would prefer a system where the Fed had some flexibility and was able to step in a crisis, but that's not where we're headed, and I worry that the regimes are untested. So it's all very well to talk about an orderly liquidation, but who's left that's too big to fail? I don't think that the FDIC is going to do a little weekend re-engineering of, I'll mention JP Morgan, probably the safest bank in the world, so there I can say them, but that it's an extremely complex institution, and the idea that an untested statute will reassure people if an institution were to look shaky, I'm not so sure. On a practical level, there's a good solution here, and so I think that we shouldn't worry so much about these things, but really do what the bank regulators have been doing, which is make sure banks have enough capital to withstand a big loss and keep an eye on them.
Okay.
I would hazard that actually the post-crisis reform agenda has made things worse. I think we've now got a more concentrated set of players in many different fields in the global market. So certainly if you take clearing as an example, the CFTC's data that shows the number of clearing members in the US is dramatically reduced. That therefore has increased a concentration in a very small number of players. And those same players are acting globally. So they're the same big players in all the CCPs around the world. So, have we got rid of too big to fail? No, I think we've concentrated risk. And I think the more complex the rules become, the more you have a benefit of scale in actually being able to put those rules in place, which means your barriers to entry also go up, which means you have less players coming in. So you end up with status quo, much more concentrated. So I think we've actually created a much more crisis-driven potential future problem.
Yeah, just a quick question to clarify. Do we think that the too big to fail goal is impossible to achieve and we shouldn't have it as a goal? Or do we just think that we haven't achieved the goal?
I think ultimately the rule makers need to step back and say, what are they actually trying to prevent? And if the system actually has safeguards within it, you shouldn't be worried about too big to fail. You should worry about the system as a whole and protecting the infrastructure. If you manage to do that, then individual institutions should be the secondary effect.
Yeah, I think that's an interesting way to look at it. Clearly, post-crisis, we haven't solved the problem of bigness, if bigness is a problem. We've biggered ourselves. Sorry, that's a Dr. Seussism. I'm not quite sure what small enough to fail means. I don't want to pick on JP Morgan or Citi, but or any of the mega banks, but you could break up any number of the largest banks in half and still have 2 institutions that would still qualify for too big to fail. Then you could break them again into 4 banks and have 4 institutions that are too big to fail. I'm not sure how far down you have to go in order to get to something where you think that you've solved the too big to fail problem in that respect. And this drives me to a fundamental issue, which is in this notion, I mean, setting aside the too big, we accept that we don't want parts of the financial institution to fail, that there is, beyond the commercial aspect of the service that we provide as an industry, there is a social aspect, call it, which is that we don't want deposits, at least, to fail. We cast a sort of social safety net around deposits because we want our financial system to be able to turn demand deposits into long-term financing for the economy, and that's a trade-off that we accept as a society. And part of accepting that as a society is that there are greater regulations on financial institutions, and there is some form of safety net which may be distasteful to those who would like to see government support entirely out of the financial system, but it remains real as long as you want to know that at the end of the day, there is some form of protection around deposits. So this problem isn't going to go away in that respect. So the question, how we put it into, I like the sort of dichotomy between yes and no. The answer is yes, we have the tools in place, I think, to address a failing institution. Probably. So the answer is no, we won't know that until we actually test it, until we actually have to go through the resolution of a globally systemic institution. So, and obviously it's something we would rather not test. So I feel like saying we'd rather not find out whether we've got the answer to that question.
Carl.
Yeah, there are 2 or 3 dimensions to that issue, which you mentioned, Steve, but also, first of all, let's say there is the debate which is going in the US, which we heard a moment ago. If the US, with the Republicans in the administration now, would go back to a system, we let banks fail, we revise Title II of Dodd-Frank, it will be a fundamental change for the framework which we have put on at the global level of bail-in and of TLAC and MRL. So that is, first of all, my question. Let's say, what will the US do? Are they really serious with what they're going to do and the commitments which we undertook, say, 5 to 7 years ago? Secondly, Europe is still busily implementing its BRRD, its Bank Recovery and Resolution Directive, which is basically our bail-in directive. And there are still many questions around. Let's say, will the bail-in, say, be effectively applied? We are looking to Italy, but since you're in Portugal today, look at this country, which had the first bail-ins already before the new directive came into force, but which is still struggling with 2 other cases. So if you still have time, let's say, try to read some newspapers or probably speak to some people from over here. They have a problem, and the question is still, will this framework work? But it's also related to the broader question. If we were to say, look, in the end, as Eric was saying, or as others were saying, we see that policymakers will in the end always extend the safety net. That means that people, certainly in Europe, will always put their money into deposits because they will be safer than they will put anywhere else. So our money, certainly in Europe, will not go to the capital markets. And there comes the third element, which is capital markets union, of which we're speaking since about 2 years. And where is it? Or since 3 years. Where is it? I would say almost nowhere. I mean, if you compare the US to Europe, US has probably more than the double of 3 times as many assets in equity and in funds as Europe has. Europe has more than the double in deposits as the US have, if you compare on a proportional basis. So if the Europeans think our deposits are protected, we'll never get a capital markets union. And I think just to make sure that there is an alternative to our banks, we need to have a well-functioning capital market model. And we don't have it, and I really regret to say I don't see it advancing.
We're going to try to, we're almost out of time. We have one more question, and I hope we end on a positive note. And the question is, are you optimistic or pessimistic that the reputation of the financial markets is improving and that this bodes well in terms of financial regulation? Just repeating that this is the last question. Okay. somewhat optimistic. Eric, how do you feel about that?
Well, we discussed this question when you were preparing the panel, and I said if you wanted to be popular, you shouldn't have gone into finance. I suppose the way to answer this is from a relative perspective. We've probably put a significant part of the post-crisis reform behind us. And in that respect, I think you can argue that we are in a better place than we were from 2009 to 2013. I think we are seeing a financial system that is much more robust, where there have been significant reforms to the banking system, significant reform to market infrastructures. There is much more cause for optimism in the stability of the financial system. There's also considerable more cause for optimism in growth generally. Unfortunately, it's still an argument we discussed earlier is still playing itself out in the political spectrum in the debate between some of the more populist tendencies and some of the more progressive tendencies that we see. But the upscale is that relative to where we've been, I'm somewhat more optimistic, but I don't think you'll ever get to the level where there will be a great deal of positivism around the notion of working in financial markets, if that's your question.
That's a good point, but who's very pessimistic? I'm just kidding. Kay?
I personally am fairly optimistic that we're in a much better place now than we were back in crisis mode. But I would say that reputation is easily lost. And so be very, very careful as you start to implement things like MiFID II, that you don't try and game the system. Make sure you actually adhere not just to the rules as you've been given them by your legal team, but also by the spirit of what was intended. It's a huge amount of legislation. We know it's not perfect, but don't look for those loopholes because your reputation's at stake. And certain financial districts are at stake in terms of their reputation if you start exploiting loopholes in large pieces of legislation. Everybody knows what the intent was, and I think it's up to those operators and participants in the market to actually adhere to those principles and actually make sure they try and keep their reputation squeaky clean from now on. It'll make my job a lot easier.
Great. Darcy, how do you feel about it?
Well, I think people like to make money, right? I think that's why most people are here in the room. And the markets have been performing broadly positively for a couple of years, so it tends to make people happier. And what will happen after central bankers tighten a little bit, interest rates go up? We've been a long time without a recession now, knock Formica up here. But I think, in 2 or 3 years, if there is a slowdown, a kind of natural economic cycle, I think people will be less happy. And so I think it all turns back to, at the highest level, what political leaders do to try to stimulate growth in the economy. And as long as things are growing and continuing to grow and people feel positive about their own personal outlook for their family and their community, they're more likely to judge the financial markets also as doing well.
Sure. So I just want to give an optimistic note on the U.S. And I realize there's a lot of, noise is the polite way of putting it in the U.S. But I look at what the action will be rather than the rhetoric. And the action I expect, we already see some change in regulation, writ large, some undoing of the last-minute regulations, such as the worst of the worst regulations are being undone, and I expect that to continue in the U.S. And then second, I would expect by the end of this year to have a change in the U.S. tax code that improves our competitiveness. I don't know that we're going to have a 1986-style tax reform, but we will have an improvement. And those are two big and important steps that I think are grounds for optimism in the U.S.
Last word goes to Carl.
Yeah, Steve, the answer to that question is very easy. I would be very optimistic if a country like France elects a former investment banker to become its president. A country like France, whatever Le Pen did against him, whatever Mélenchon did against him, they elect the president as, a former investment banker as the president. You can only say, look, it's over the crisis, we're back in the good old times.
So let me well said. So let me quickly sum up. We've made progress. We've worked hard to implement G20 reforms. That is helping the reputation of our markets. We have to be very vigilant that we don't lose the goodwill that we're earning. Some of that goodwill will depend upon future economic growth and the health of our markets. And there are some hopeful signs of spring in the world's financial capitals when it comes to NESPA, financial regulatory reform. All that's left for me to do is thank Kay, Eric, Darcy, Philip, and Carl for being a great panel. Thank you all for listening. Thank you.